So you are a longer-term investor. As you look at tech, which has driven so much of investment over recent years, can you project that it will keep growing that way, given all the things that we've talked about, geopolitical risk, regulatory risk?
I think one of the things that I think about most with respect to tech is the fact that tech is everything. It's not just one sector. There's not a single sector you can think of that has not been affected by technology. So what exactly is the tech sector? Is it information technology, or is it real estate? I mean, real estate is affected by tech. So I don't think that the tech trends are changing. I think how you invest in it and the ways it's implemented may change, but tech is here, and it is changing the dynamics in ways that are really important. And I think that our regulations, the government, the way we think of things haven't kept up with technology, and that's causing the ripples and that's causing the problems, because how exactly do you control technology? We're struggling with how to do that.
But I think one thing we've seen in tech is the network effect and the scale that benefits so enormously, whether it's a Google or it's a Facebook, or perhaps we're seeing it now in the cloud, really, with Amazon and Microsoft, something like that, where it's unusual. Typically, when you get too big, it starts to get too expensive. That doesn't seem to happen in tech. That's a different phenomenon.
Yeah, and I think that has a lot to do with another problem we're having, which is the lack of inflation, right? I mean, it puts a lot of pressure on a lot of things that have sort of underpinned how long-term investors invest. There's certain things we rely on to make decisions as long-term investors. And the way we construct our portfolios have a lot to do with what we think will happen with different industries, with different governments, with regulations. And a lot of that's coming undone. And a lot of it has to do with technology. And a lot of it has to do with how people include it in their portfolios and think about it, and how governments are thinking about regulating it. And I think that's going to be interesting to watch. But I don't think the end of we're looking for an end to technology, or the end the impact that technology is going to have on markets. I think it's going to be a fundamental part of it, and if people don't understand it or have an opinion on how it'll affect different industries, different countries, the relationships between countries, the relationships between governments. I think, you spent a lot of time earlier talking about China versus the United States and the two systems that they're going to have to force other countries to choose between. That's real, right? That's going to be a real significant part of how we think about investing, because we used to think about it globally, and now we're going to have to think about the countries that choose to align themselves with China versus the countries that choose to align themselves with the United States. And arguably, those two different factions will be diversifiers for each other, but that's not exactly the way we've thought about it in the past, and so we're going to have to rethink. And I think that's going to be interesting to see who does it well and who doesn't.
I think there's also, as you, I think would agree, Kim, that in technology, I mean, over 10 years ago, where was a Facebook? Where were some of these companies? And Microsoft seems to be the one constant in technology throughout this time period. So over the next decade, you could argue who's going to be the next big tech company. You mentioned the cloud. That's a huge thing. Now you've got all these other companies, these smaller companies that can grow because of the cloud, because the costs were too prohibitive for these smaller companies to grow. So I think 10 years from now, who knows who will be the bigger tech companies.
Well, the fundamental challenge is there going to be a platform shift before there's a regulatory tipping point where governments come in to actually try and break down some of these large companies, or whether national security interests are going to predominate. But I think investors and economists and policymakers are really struggling to get their heads around this, because I'm actually trained as a cultural anthropologist, not an economist, and the tech sector is very hard to measure or track using traditional economic tools that look at money, because so much of the transactions are based on barter of services for data, which are not captured through money. And antitrust regulators can't really cope with this, because all of their methodology is based on whether consumer prices are rising or falling to see if there's a monopoly. Economists can't count this stuff, so our GDP figures and our inflation figures could be completely out of whack. And I think also investors are having trouble trying to work out what is actually the value of a company where almost everything is intangible and based on things like barter rather than actual economic numbers.
It's a really powerful point I had not thought of before in this sense. Some people are saying we should have rate regulation. It's like the railroads, where you just start regulating the rates because they're so big you can't get your arms around it. But if it's really barter, it's much, much harder to have rate regulation if it's not denominated in dollars and cents.
I couldn't agree more, and I am firmly of the opinion that we have to turn around and say very clearly, this is barter. And we have to recognise the real problem today is actually not that it's an entirely one-way trade, because it's not. We're giving up data for services, but are the terms of trade for regulators clear to both sides, and are they fair? And at the moment, there's so much opacity and confusion around the debate, that issue isn't even being discussed properly.
I think that's exactly right. I think that's exactly right, because we absolutely looked at these companies and we looked at these industries from a traditional lens, and then realized later, oh, I was trading something that I didn't realize I was trading, right? And then you're like, I priced it wrong, because I should have made them pay more for this thing that I was giving them. But now it's too late, right?
But as you construct and reconstruct your portfolio and look at the longer term returns, how do you take into account the fact that everything is tech? As you said, in a sense, everything's tech. But how does it influence your decisions about what to invest in and what not to invest in?
I think what we're trying to do is think about where there's going to be value. Because ultimately, I do think at some point the market recognizes value. And so technology is going to destroy value for some industries, and it's going to create value for others. And so we're trying to figure out which companies, which countries, which industries are going to benefit from the fact that technology is pervasive versus which ones are going to come undone as a result of technology. And as a long-term investor, that predictability becomes important. And so there is a little bit, to the point of, you guys were talking about ESG earlier, and that's an industry that for sure is going to be swayed pretty significantly because of technology, because that's what's going to make it possible for people to get comfortable with solutions to climate change.
So Seema, where do you find value as an investor at Morgan Stanley?
So again, we talk to our clients about long-term investing because they're all long-term investors, similar to how Kim is. And, from that standpoint, we try to invest through a lot of the ups and downs of the market. So again, we focus on global companies, global franchises that, build value over time, compound over time, that will consistently have pricing power because of that, marketplace stance that they have globally. And that, we think, is just a better long-term way to think about investing. And it's a lot easier to talk to clients about the long-term than try to get them focused on these short-term vibrations in the market, which you need to pay attention to clearly. But again, we're investors over the long term.
I love the word vibration. It gives a very happy feeling to the stock market. Don't worry about the crash, it's just the vibration.
Yeah, it's interesting, when we're talking about value, you're not talking about value versus growth. You're talking about intrinsic value.
Intrinsic
so
value.
You're not saying something that you're going for value stocks rather than growth stocks.
Right, no. I'm talking about the fact that there is underlying value that's worth owning, that's going to be created by some technologies, and there's going to be some destroying of value. It was a really interesting conversation I had with a young man recently where he was telling me, and I love talking to young people because they give you a totally different perspective, and his perspective was that the companies who don't make very much profits are the ones that have the moat, because it reduces competition. That's why Amazon's winning, right? Because who can compete against them when their margins are so thin? And so it's an interesting dynamic that's been made by technology. I mean, technology has made that possible for them to create a moat around themselves that way, right?
And Amazon, I mean, really, what is it? It's a logistics company.
It's a logistics company.
Right? It's
Exactly
not a
right.
retailer. Maybe it was in the beginning, but clearly it's a logistics company.
Yeah.